Hi, everybody. It's Peter Schiff. It is Friday, February 1st, 2013. Well, the Dow Jones closed above 14,000 today. That's something it hasn't done since November of 2007. Of course, the media is going to make a big deal about Dow 14,000. The economy is coming back. The markets are coming back. But of course, all of this is an illusion created by inflation. When you debase your currency, when you have inflated dollars that you use to measure stock prices, of course stock prices are going to go up. The price of everything is going up. The government denies there's inflation, but prices prove it, as if we even need that. The money supply going up is the sheer definition of inflation, and we're creating a lot of money, and prices are responding by rising, and stock prices are no exception. But remember, the last time the Dow Jones was at 14,000 back in 07, gold was about $700 an ounce. Today, gold's about $1,600 an ounce. So the Dow would have to double from here, and it still wouldn't be where it was in terms of real money 5.5 years ago. So this rally is an illusion, but the people on Wall Street don't even want to acknowledge that. I was on CNBC earlier today. In fact, if you go to my YouTube channel, at Schiff Report, we're going to post that CNBC appearance later on so you can check it out. But somebody interrupted me, or of course I probably interrupted them too, but they said that I needed to check my ideology at the door, as if somehow I had to forget about my ideology and just enjoy the ride, just acknowledge that stocks were going up. I did acknowledge that. I'm just trying to put it into perspective so that people understand why they're going up. Or more specifically, that they're not going up, that it's the value of the dollar and other fiat currencies that's going down. Because it's important to understand why things are happening, not just, ride the trend, but know what's driving it and understand that it's not good fundamentals. It's not an improving U.S. economy. The fact is the stock market is going up despite the fact that the underlying fundamentals for the U.S. economy are actually getting worse. Everybody is talking about all this economic growth. What economic growth? The only thing that's real is the debt. Look at all the money we've borrowed to get this phony economic growth. We are trillions and trillions of dollars deeper into debt, and all we have to show for it is the used stuff that we bought. We're not richer. We don't have more factories, more plant and equipment. We just have more debt, and we delayed the day of reckoning by borrowing and printing money. Meanwhile, we're getting closer and closer to that day. We got a lot of economic data that came out this week. Today, we got the jobs numbers, the non-farm factory payroll numbers for the month of January. And we created, I think, 157,000 jobs. That was slightly below consensus, although they did revise up some prior months. But of those jobs, only about 2,000 were in manufacturing or goods production. So these jobs aren't making our economy stronger. They're actually making it weaker. The people who got jobs in the service sector, they're not producing stuff. They're going to spend their paychecks on imports. So the trade deficit is going to get bigger. That's one of the reasons that the GDP was so weak. I'm going to get to that in a minute. I want to finish up with the jobs numbers. The unemployment rate notched up to 7.9 from 7.8. Who knows? Maybe this is the last month we'll be below 8%. I think we're headed back up there. In fact, the only reason that we're not at 8% right now is in January, about another 160 some odd thousand people left the labor force. In fact, that's been the whole story of this phony Obama recovery. If the labor force participation rate was still what it was when Obama was sworn in, the unemployment rate would still be 10%. And of course, if we count all the people that are working part-time that want to work full-time, it's still over 14%. So it's not that people found jobs, it's just that they became so discouraged that they quit looking, and this is supposed to be an economic recovery. Let me get back now to the GDP numbers. We got the first look at the fourth quarter GDP, and U.S. GDP actually contracted by 0.1% in the fourth quarter. Now, this is the weakest quarter of the Obama presidency, except I think for the very first quarter when he was just sworn in the first quarter of 2009. So coincidentally, for the president, we got this number after he was reelected. Of course, he was campaigning on this great recovery, but now we find out that the economy actually contracted, even by the government's own estimates, in the fourth quarter of the last quarter of his first term. Now, I think that the economy contracted more because, again, the government is assuming that inflation is practically non-existent. So really, the nominal GDP is masquerading as real. But I think that the economy is contracting because I don't believe the government's inflation numbers. I think inflation is significantly higher than what the government assumes when they deflate that nominal GDP to arrive at what they pretend to be a real number. Now, a lot of the pundits are dismissing the weak fourth quarter. It's an aberration. It's due to drops in defense spending or buildup of inventories or widening trade deficit. Look, they can make all the lemonade they want out of these lemons, but it was a weak number. And even if you look at the GDP numbers for the entirety of 2012, the economy only grew by about 2%. Now, where are we in 2013? Well, we just had tax hikes kick in. So now everybody is going to be paying higher taxes. We had a big, 2% jump or a 2-point jump in the payroll tax, which is a lot more than 2%. I think the average guy who's earning $50,000 is now going to pay $1,000 more in payroll taxes. Interest rates are now moving up. Take a look at what's happening to the yields on 10-year treasuries, now above 2%. Look at the 30-year treasury. I think it's above 3.2 or something like that. But rates are moving higher. So we're getting higher interest rates and higher taxes, and the deficits aren't coming down. The deficits are still getting bigger. And this is despite the fact that the Fed is printing $85 billion a month now to monetize bonds and mortgages. Rates are moving up despite this. So I think whatever economic growth we managed to manufacture in 2012, it's going to be worse in 2013. In fact, the Obama recovery was the weakest recovery on record. And if you think about how weak the Obama recovery was, imagine how bad the Obama recession is going to be, because it might have already started in the fourth quarter of 2012. And look at where we're starting from. We're already at 0% interest rates. We're already at 8% unemployment, well, 14% if you use the U6 number. And that's as good as it gets during a recovery. And now we're already trending down. And I think if the Federal Reserve wants to slow down the rise in interest rates, which we know it does, it's going to have to accelerate the QE. I don't think $85 billion of money printing is enough to keep interest rates from rising. And so they're going to have to print even more. That means the dollar's going lower, commodity prices going higher. Look what's happened to oil prices. They're almost at $98 a barrel. Look at Brent. Brent crude is really up. It's almost at a $20 premium now over North Sea. Gold prices have been stable, but I think gold's about to take off. I think on Wall Street, they're rationalizing. They're selling gold and selling gold stocks because they claim that the crisis is over. There's nothing to worry about anymore. Europe isn't falling apart. The U.S. economy is getting better, so there's no reason to own gold. And so you sell gold and you sell your gold stocks. But they don't understand. People weren't buying gold because of the European crisis or because of even the U.S. financial crisis. They were buying gold long before those crises began. Look at how gold was doing from 2000 to 2007, 2008. It did better before the crisis than it did during the crisis, because the real crisis that worries the gold buyer is a currency crisis. People aren't buying gold because they're worried about political uncertainty. They're buying gold because the politicians are printing too much money. Well, the cheap money policies that were in place prior to the 2008 financial crisis are still here, only it's worse. It's more excessive. The monetary policy is easier. Rates are lower. Central banks are printing money even faster. So instead of there being no more reasons to buy gold, the reasons have never been better. There have never been more reasons to buy gold. It's just that Wall Street doesn't understand this yet, but they will. Looking at the U.S. dollar versus other foreign currencies, the dollar hit new 52-week lows today against the euro, against the Swedish kroner, against the New Zealand dollar. But it was a mixed picture because the dollar hit a new 52-week high against the Japanese yen. It was also much stronger against the British pound. But that's not because of dollar strength. It's because of pound and yen weakness. It's just that right now, as weak as the dollar is, the pound and the yen are even weaker. Expect a lot more money printing from Japan, a lot more money printing from the UK. That's just going to drive even more demand into gold as savers and investors flee fiat currencies looking for a real store of value. Of course, a lot of that money is still going to go into the global stock markets. People are going to buy stocks, but you have to be cognizant of the real reason that stocks are going up. It's not because things are good, it's just because there's a lot of inflation, and if you don't get rid of your currency, you're going to lose purchasing power, that particularly when it comes to the U.S. And I mentioned earlier this bond bubble, interest rates are headed up, and the Federal Reserve is going to have to print even more money to prevent the air from coming out of that bubble. But imagine when the public, you've got a lot of mutual funds that are loaded up with bonds. The public has bought bonds for the last several years, despite the fact that they're overpriced. They trade in the rearview mirror. They're looking at rising prices. They don't understand it's a bubble, but there is tremendous risk in the bond market. If people actually want to move money out of bonds into stocks, and maybe the 14,000 on the Dow, hey, that might be a sign. People might be talking about that, hear it in the news. Hey, let's get into the stock market. Well, they got to pull money out of the bond market. So that puts more pressure on the bond market to go down. And if the Fed actually were to stop buying like it's threatening to do, and the Treasury has to keep on buying, Congress just voted this week, the Senate, I think yesterday, they went along with suspending the debt ceiling. So we're going to get more debt. And in fact, I think Congress is going to use the decline in fourth quarter GDP as an excuse to cancel all the spending cuts that were part of the sequester. Not that they were significant cuts anyway, they were trivial. But I think they're going to look at the decline in the fourth quarter. They're going to blame it on cuts in government spending. In fact, the Obama administration is already doing that. They're already blaming Republican austerity for the decline. I mean, austerity, no one in the Republican Party is talking austerity. I mean, we need that, but we're not going to get it. They're talking trivial cuts that aren't even going to take place. But I think that weak fourth quarter GDP is going to give the politicians all the cover they need to recklessly cancel those spending cuts and crank up the deficits even bigger. And the Fed, I think, will respond by upping the size of its QE. Also, we got the consumer confidence numbers that just came out this week, and consumer confidence is now at a 14-month low. Now remember, it was at a 5-year high the month before the election. Now what's changed since then? Well, the only thing that's really changed is Obama was reelected. I mean, the public, they're still getting this good news from the media. Home prices up, the stock market up. I think what happened is before the election, there were a lot of Republicans who actually believed their guy was going to win. They thought Mitt Romney was going to win the election, and that's why they were confident. Of course, the Obama administration used those numbers to talk about confidence in the recovery, in the Obama economy. The only reason those Republicans were confident is because they thought Obama was going to be a one-termer. They weren't confident in the economy as it was at the time. They were confident that it would improve once we got rid of Obama and elected Mitt Romney. Now, they were probably wrong about that, but now that we didn't elect Mitt Romney, there's no reason to be hopeful. They have to now get used to the fact that it's 4 more years of Obama, and I think that's why the consumer confidence numbers are coming down. And, people are going to become a lot less confident as times go by. Because, it's not just the stock market that's going up. Gas prices are really starting to rise. I think you're going to see, food prices, other prices, everything is going up, and the jobs are not going to be created. Obama thinks, and a lot of people think, this is going to be his second term is where, he really establishes himself, creates his legacy. It ain't going to work out that way. This is where the chickens come home to roost. Because he let a lot of them loose in his first term. He planted a lot of seeds of destruction that didn't germinate yet. They are now. Now we're going to have to deal with Obamacare. We're going to have to deal with the trillions of dollars of debt that were taken on in order to buy this phony recovery. And the world is going to figure out that the Fed is all bark and no bite when it comes to tightening or withdrawing the liquidity, because that's the only thing keeping this phony economy afloat is cheap money coming from the Fed. Speaking about the Fed, we actually got the rate decision from the Fed earlier this week. Not that there was any doubt what the Fed was going to do. They agreed to keep interest rates at zero and to keep printing $85 billion a month to buy treasuries and mortgage backs. They said they would continue to do this until the unemployment rate is below 6.5%. Well, it's already going the other way. The other goalpost was inflation. And the Fed said that they would continue to print money or continue QE until inflation, using their own measures, was at least 2.5%. Not immediately, but 2 years in the future. Think about that. The Fed is not even saying it's going to stop the presses if inflation hits 2.5%. No, it's what the Fed thinks inflation is going to be 2 years into the future. So even if inflation, as the Fed measures it, goes up to 4 or 5%, they're still not going to stop easing, because they're going to say, well, this is only temporary. It's due to a spike up in oil prices or bad weather. And we think that 2 years from now, we'll be back below 2.5%. So we're not going to take our foot off the pedal. We're going to keep on doing QE because we don't think that there's an inflation problem. Well, in those consumer confidence numbers, coincidentally, consumers were asked what they expected prices to do in 2013. And they estimated, the mean estimate was almost a 6% increase. So when Bernanke talks about inflation expectations being well anchored, maybe on Wall Street, maybe people who don't actually shop and don't look at prices, maybe they think there's no inflation. Central bankers don't think so. But Americans who actually go to the market, who actually clip coupons and compare prices, they know that there's inflation because they actually experience it. They actually feel it. I think a lot of the bankers are in for some sticker shock one day when they realize just how much prices have gone up during a time period where they thought there was no inflation. Anyway, that's it for now. Don't forget to listen to the Peter Schiff Show on schiffradio.com. We do that Monday through Friday from 10 a.m. to noon. And if you can't listen live, just go to schiffradio.com. You can listen to the rebroadcast. We loop it the entire day. Take care.